So it's very much related to the previous paper. This paper is going to build on work I've been doing for 10 years on trying to model the transmission of monetary policy through the banking system. So it's part of a bigger agenda. So in standard monetary approaches, in particular the New Keynesian model, we've been very good at articulating what's called the interest rate channel. The idea that if you have nominal rigidities and you have an instrument, a nominal instrument, you can move real rates, and that has an effect on the economy. An earlier tradition articulated well an inflation tax channel, the idea that if you move the inflation rate of the economy, that generates certain distortions, and that's how you have movements in real activity. But in both instances, in the New Keynesian model and in the more monetarist tradition of the cash in advance or new monetarists, there's a single instrument. And what we've been doing in this agenda is trying to be explicit about the implementation of monetary policy through the banking system, modeling the special role of reserves in settlement of interbank transactions. And in that world, there are many short-term rates. Like in the previous paper, there's a loan rate, there's a deposit rate, and central banks have more instruments that we traditionally think about. They can control a base rate, and they can control spreads among base rates by moving the quantity of reserves in the system. So in some sense, central banks ride on financial frictions by making them less or more stringent as an extra instrument. So the main insight of one part of the paper is that you have two instruments for two potential targets. So in this model, in equilibrium, you're going to end up with a loan rate and a deposit rate that share a common interest rate on reserves as a base, and then deposits and loan rates command what we call a liquidity premium coming from certain frictions, and I'll be explicit about them. By playing with the quantity of reserves, the central bank can alter these liquidity premia, thereby moving credit spread. So those are two targets. And what we're going to do is take that insight and we're going to plug it into a model that has this implementation, this effect on spreads, in an environment with incomplete markets, with wage rigidities, and we're going to study the effects of changing these two instruments, and we're going to articulate an idea that the central bank has the standard channel of monetary policy, the real interest rate channel, but at the same time controls a credit channel in this incomplete market economy. So there's going to be three regimes in this environment. One regime is a corridor system where the central bank operates with a lean balance sheet. So what that means is that the quantity of reserves is scarce, thereby driving a spread between the loan rate and deposit rates. And in that world, or in that regime, both instruments have a role. You have a standard interest rate channel, and you have by playing with the quantity of reserves, you have an effect on the credit channel. And I'll be explicit about what that is. You have a floor system, which is a situation where if there are sufficiently high amounts of reserves, you're flooding the banking system with reserves so that spread is gone. Essentially, banks are satiated. And then there's a third regime, which is a deposit zero lower bound. So it's a zero lower bound on the deposit rate, which happens when the interest rate on reserves is negative. And what happens in that regime is that you have a standard liquidity trap. Any open market operation is transformed into currency. And furthermore, if you play with the interest rate on reserves, if you reduce the interest rate on reserves, in that regime, what you end up happening is that instead of seeing both the loan rate and the deposit rate falling, you have a reversal effect. The deposit rate stays flat and the loan rate goes up. So you have an interest rate reversal. And so you have this interest rate on this dimension and the quantity on this dimension. And so, depending on the quantity of reserves and the interest rate on reserves, you can be in either these three regimes. So that's the articulation of, the geography of how policy maps into different regimes. And then the question is, why does this matter? Why do we care about this? Why do you need a model with spreads, heterogeneity, a zero lower bound, and why do you need shocks? So it seems to be that we're doing many elements, but the reason why we need all of this is to articulate what came out in the earlier the discussion of the earlier paper, which is articulate a notion that playing with the quantity of reserves has a role in stabilizing the macroeconomic system. So it's very much in line with Kashyap and Stein. So the message in the paper is that when you're in a boom, you want to operate with a lean balance sheet, with a small balance sheet. And that sounds like bad, because in this model, when you're not providing sufficient amount of reserves, it's close to what Friedman would tell you you're doing things wrongly. You're far from the Friedman rule, because you have a spread that you're away from satiation, and the Friedman rule tells you be close to satiation. We're going to say, no, that's actually good. It's good because it contracts the amount of credit in the economy, and that's going to be helpful. The reason for that is that you can have a crisis. You can have a shock to, say, the discount factor or the desirability of lending. And what you want to do in a crisis is expand the balance sheet, like drive down spreads. You want to drop interest rates all the way to the deposit zero lower bound. You can go beyond the deposit zero lower bound by lowering interest rate on reserve, but that's contractionary, so you don't want to go there. So that's why we have a ZLB. And the reason why, and so this situation in a crisis, or these two policies, are the limits of what monetary policy can achieve. This is going to the deposit zero lower bound and injecting vast amounts of reserves until there's satiation is the limit of monetary policy. So that's the best monetary policy can do. And the reason why you want to have scarcity of reserves before you have a crisis is because this policy becomes more powerful in a crisis. So there's a precautionary behavior. So you sacrifice a distortion in booms to get more power of monetary policy during crisis. So there's a stabilization effect. So you sacrifice microinsurance. We have incomplete markets, so when you have a spread, there's worse insurance, but you gain what I call macroinsurance. So the message regarding the current policy debates is, don't flood the system with reserves always, because you're sacrificing an important instrument. And to make the statement, I need all of these elements. So what I'm going to do next in the presentation is try to strip down all the necessary elements. So
just a clarification question. The intuition here is that by increasing the spread ex ante, I reduce credit and therefore make the crisis exposed less severe.
See, this is the purpose of this slide.
Okay.
So in this model, we're going to be explicit about a balance sheet policy that you cannot do in a standard New Keynesian model because there's no balance sheet. Having a balance sheet policy allows you to control spreads, credit spreads. That has two effects. First, by conducting open market operations, you have a standard credit channel. Because when you jack up a spread, you reduce the demand for loans and the aggregate demand as a result. So this is a standard credit channel. But second, by moving credit spreads, ex ante, you have an effect on the economy, so in the distribution of wealth in particular, that by affecting the quantity of credit, basically how much credit is in the economy, it enhances the power of the standard instrument, of movements in the real rate. So you have two effects. You have an effect of controlling spreads, and you have an effect of, by affecting, you have an effect ex post of controlling spreads. So that allows you to control aggregate demand. But also, ex ante, if you had spreads over time and you limited the quantity of credit in the economy, holding a spread fixed, so forget about this, holding a spread fixed, moving the interest rate on reserves becomes more powerful in stabilizing demand, aggregate demand. So it enhances the interest rate channel. It has a macroprudential feature of mitigating the size of shocks, but it's bad, or having tight credit is bad because it produces, this should have been in white, worse microinsurance. So there's a trade-off. And we're going to find like an intermediate optimal size of the balance sheet and interest rate and reserves. So that's the paper in a nutshell. So the rest of the presentation is going through the equations and the results. So the paper has two blocks. Has a interbank market block that you can embed in other frameworks. You don't have to work with incomplete markets. Any model that has a demand for loans could work. And then it has the incomplete market block. So let me prune into the bank block. So this is how it's going to work. So the purpose of this block is to induce a micro foundation for a demand for reserves, as you saw in the earlier presentation. So we have these banks that are static. There's nothing dynamic. They open one period and then they close the next period. Super simple. And they're intermediaries because they borrow money from savers in the economy, and they lend to borrowers in the economy, and they hold for reserves for a precautionary reason that I'll describe in a second. And they're competitive, there's free entry, and there's no equity. And the budget constraint is as simple as this. They issue some deposits, and they hold some deposits in reserves and loans. So there's no equity here. There's no constraint on the banker or anything like that. And I'm going to use capital letters to denote aggregates. So when you move to the banker's problem, forget about this settlement term for a second. I'll describe it in a second, but just look at this term here. The banker's problem is to maximize profit, and it has three interest rates associated with the three assets that it holds. They command different rates of return. So if you forget about settlements, this is a linear program, so all rates should be equal. But there are frictions here in the settlement of reserves. So what happens is that when banks are making loans, the deposits can circulate across banks. What this is trying to capture is that people make payments across banks. So some banks, if they are lucky, they end up with a balance of reserves equal to the original amount. But if they are unlucky, some amount of their deposits are moving to another bank, and so they have to, they will hold effectively a lower amount of balances. So you have some banks that start the morning with some amount of reserves, some deposits move to another bank, and they have to pay the other bank with reserves.
But they don't receive deposits also?
They receive deposits, but the idea is that when you receive deposits, you should be paid with reserves, but that doesn't enter your balance because that's before settlement. This is the balance before settlement. But effectively, as you said, whatever comes out stays in the banking system. But just like for accounting for a balance, it doesn't matter. Okay, so why is this important? So in earlier work with Javier Bianchi, what we do is we model like a dynamic interbank market. And really what we're doing is just solving a paper by Ricardo Lagos and Garafonso, Econometrica 2015, which is a sequential model for matching in the interbank market. And what we do is we make assumptions so that we get a closed form, of that paper. But it's a very convenient closed form because you can embed it in models very easily. So the idea is very similar to what you find in labor models. So it's like a search market for reserves. It's like some banks are going to be in deficit, those that receive a negative withdrawal shock, and then some banks have a surplus. And they match, and they bargain about a Fed funds rate. And so the tightness, the market tightness, is the ratio of banks in surplus versus the banks in deficit. So that gives you a market tightness, like theta. And what we do is we essentially map market tightness from a sequential model of interbank trades into a single function, a kink function that we call chi. Okay? So chi says if you're a bank in surplus, there's a term, a common term, chi plus, that encodes all the trades in the interbank market. And that's the average rate that a bank with surplus receives by lending in the interbank market. If you're a bank in deficit, you receive chi minus. Where do these terms come from? Well, there's this sequential trade, and the outside options of those trades in the interbank market are the following. If you're a bank in surplus and you match, when you bargain, you know that your outside option is lending your excess reserves at the interest rate on reserves. And if you're a bank in deficit, what you do is you can borrow from the discount window. So it's the rate on reserve plus a penalty. Okay? So now think of a search model. You know, the higher the tightness, what that means is that there's more deficit relative to reserves. So what that means is that the average rate will go closer to the ceiling of the discount window. And if there's plenty of reserves to be lent out, you go to closer to the floor of the system.
Penalty is more like a stigma, or what is it?
This is like, you can think of the discount window rate or discount window rate plus some stigma. You know, or collateral cost or whatever. But now go back to the earlier problem. So this is a linear problem, but you have this kink function. And if you have a kink function, that's concavity. Concavity doesn't rely on, you know, smoothness. It's just you have a kink. So once you have a kink, this leads to interior solutions. So in equilibrium, the rate on loans equals the rate on reserves, as I showed you in that earlier slide.
The kink is why you have the three regimes.
The kink is the source of the three regimes. The source of the three regimes. So in equilibrium, the loan rate depends on the shadow value of reserves. So what's the shadow value of reserves? Well, if I hold an extra reserve, I earn the interest rate on reserves. But if I'm in deficit, I save this, and if I'm in surplus, I earn this. And if I issue deposits relative to reserves, when I issue an extra deposit, I'm exposing my bank to greater withdrawal risk. So this commands a premium between the loan rate and the deposit rate. And the reason why this is important is because you suddenly obtain, if you subtract one from the other, a real spread. And that real spread depends on chi minus, which is controlled by the quantity of reserves in the system. And the reason why that's important is because, you know, even if you write a nominal model, a spread is a real object. So what that means is that the central bank controls a real object in the economy, which it influences through open market operations. So these are real effects on monetary policy. Even if you had neutrality or flexible prices, you control a real object. So that's one takeaway. So just to summarize, you're going to have two functions, and then the spread for a given iota, the spread between the loan rate and the deposit rate will be a function of these payment costs, and depending on the quantity of reserves, you can control this spread. When you go beyond this point, then you satiate the economy with reserves and the spread goes away. Okay.
Sorry, how is the...
Yep.
No, just one thing I missed. So the central bank is controlling the quantity of reserves.
Correct.
But is there a price of reserves that is clear in this market? So what happens if banks want 100 and the central bank provides 50? How are these reserves allocated?
Okay, so what clears is not the price level. What clears that market is the rate on all the interest rates, all the real rates. Okay, so what the central bank does to control inflation is it sets the path of interest rate on reserves, just like you have in the New Keynesian model. Just the path of nominal rates determines the rate of inflation. To clear the market, if there's like excessive demand for reserves, what would happen is that if there's excessive demand for reserves, it comes from the demand from deposits. So what adjusts would be the deposit rate and the loan rate, so that given the quantity of reserves, you contract the amount of deposits so that you don't need that many amount of reserves. Is that clear?
Yes.
So, okay, so if that's clear, I skip it. Okay, so you have that block.
Can I ask you a clarification?
Yeah.
This here, between, do you need a spread between IL and IM? Can you not have like chi plus chi minus equals 0? Or where?
So when you have satiation, chi plus and chi minus go to 0.
Both. Yeah.
Both. In this picture, it's like beyond this delta point. When the ratio of reserves to deposits is beyond delta, this goes to 0. When this goes to 0, you're back in the standard New Keynesian model.
But can you not have just a spread between IA and IL without having the spread?
No, I cannot.
So delta was the fraction of reserves that gets
Out. Deposits that get out.
And this is independent of the quantity of reserves in the system.
Right.
So
That's a technology.
the technology. So the idea is that the way consumers
Yep.
move across banks
Yeah.
sort of scales up
With the quantity of deposits.
the quantity of deposits.
Yeah. The idea is like if, Apple has twice the amount of deposits issued by Bank of America, that's exposing Bank of America to more liquidity risk. Because Apple can acquire a company and then it moves the money to somewhere else.
I'm not questioning I'm just saying that this is important for the real effects of.
Yep. This is important. If this was 0, then this goes away.
Scale up with the
Yeah.
amount
Yeah.
of your money
Yeah.
in a different way.
Yeah. I think if you didn't scale up with deposit, you still have like this race between M and delta. So it would still be there. Okay. So then all we do is stick this into a heterogeneous agent model with like New Keynesian features, aka Hank model. Okay, but we're going to do some things that are a little bit different. So most of the action is going to come not from the standard way we do things with, misallocation across firms. That's too complicated for me, so I'm going to do it in a simpler way. So I'm going to let the system adjust through the unemployment rates. So what I'm going to do is we're going to have these transition probabilities from employment to unemployment that have a natural rate, and you have these endogenous rates. So in the New Keynesian model, what adjusts, because you have sticky prices, is the output gap. And that's mapped into some amount of misallocation across firms. In this model, what's going to allow us to adjust quantities, given the prices are fixed, is this endogenous firing rate. So whenever there's excess or excess supply, in this model, what's going to happen is that the transition rate from employment to unemployment is going to blow up, and firms are going to fire workers, and that allows the system to adjust. Okay, so it's just a mechanism to do things more mechanically. So you have these households that face this employment dynamics with this endogenous component. They jump from employment to unemployment, and they have real income. Real income is the sum of an income that depends on the employment status and transfers. Very simple. So you have this real income, DW, and then you have the evolution of their savings. So their savings fall because they consume. If they borrow, they have to pay an interest. This is nominal loans rate minus inflation is the real loans rate. If you are a saver, you get the deposit rate, but you can also hold currency. Why do we have currency? Well, because we want to have a zero lower bound. And so we're explicit about that zero lower bound. So the quantity of reserves can be transformed into currency if it's needed. So optimality says,
Can you
Right, M is the reserves of the bank. Households can also hold currency. The only difference is that you can see here that households don't earn an interest from holding currency. So currency will only be held if the deposit rate is negative, because that's the only point in the state space where they care about holding currency. So the effect of that is that it puts a floor on the deposit rate. So when you have very low interest rate on reserves and the central bank conducts an open market operation, banks have an excess supply of reserves. Naturally, what they would do is lower the deposit rate, but households say, no, I don't want a negative deposit rate. I want to hold reserves. So this creates a liquidity trap. And it also creates an interest rate reversal. Anyway, so that's it with a household. And then the system is closed with a New Keynesian Phillips curve, where instead of this aggregate demand equation, you replace it by these unemployment flows. Phi adjusts so that the demand for goods equals the demand for output, and then we use a Taylor rule. End of the story. Okay? So the non-financial block is the central bank. It conducts the interest rate on reserves. It sets iota. It can distribute transfers. And then whenever it changes the money supply, it's buying loans. So it's conducting unconventional monetary policy. That's it. Okay. So let me show you some results. So first result of implementation regards the steady state. So this model has a unique steady state that depends on the equilibrium spread. So fix a balance sheet policy for the central bank, fix the policy rates, that pins down a spread. Okay? Depending on the loan rate and depending on the deposit rate, that affects real saving decision in the long run, independently of what happens with nominal rigidities. This is a steady state. So in this model, there's a unique real interest rate that clears the real asset market. The important message of this equation is that although the interest rate on reserves controls long-run inflation, steady state inflation, because the real rate is pinned down by this equation, this is a model where the central bank is powerful enough to control long-term real rates. So it actually decides where real rates are. Okay? So it has the influence of affecting long-term objects. A model where the size of the balance sheet doesn't have money neutrality. First message.
So can I ask something just to understand?
Yeah.
So households, in order to self-insure, use both money and deposits?
They use loans to self-insure. When you have an unemployment lapse, so you have low income, you drown your savings, and you use loans. Now, if you're at the deposits here lower bound, so namely deposit rates are 0, you're indifferent between money and deposits. So if you were to as a saver, but if you're a borrower, you continue to borrow. So savers, effectively they don't use money to self-insure, they use borrowing.
So
they use credit.
There's no cash in advance constraint?
There's no cash in advance constraint.
So in normal times, they hold 0 money.
Most of the time they hold 0 money. Is useless. It's just a perfect substitute with deposits, so money is useless.
So it's not like a Bewley model.
It's not like a Bewley model. What it does is that, again, like if you rate, well, let me go to the proposition and then I'll show you. So second proposition is that in a transition, given a spread, the way the economy works is that by affecting the interest rate on reserves, you effectively affect the unemployment rate by affecting aggregate demand. So it has that New Keynesian feature. So the takeaway is that along a transition, the interest rate on reserves controls the real rate, as in the New Keynesian model, because prices are sticky. So it controls aggregate demand. And the spread affects this wedge between borrowing and lending rates, so it's effectively an instrument to redistribute. Okay, so then we have a third proposition. So I described already what happens in a corridor system, a balance sheet system, when you essentially flood everyone with reserves and there's no spread, so you have Wallace irrelevance of open market operations. And then what Florian was asking me, what about the deposit zero lower bound? So let me quickly refresh that. So that happens when the interest rate on reserves is negative, and there's so many reserves that you're getting closer to satiation. But because the deposit rate cannot go beyond zero, cannot fall below zero, the deposit rate is flat. So when the central bank conducts an open market operation, banks end with an excess amount of reserves. And Alberto, because the deposit rate can no longer adjust, as you said, to clear the market, as you asked me to clear the market, what happens is that the quantity of currency clears the market. So currency is taken out of the banking system so that banks end up with less reserves. So this is a notion of a liquidity trap, a classic notion of a liquidity trap. So, but the other interesting feature is that in that regime, you could venture and say, well, I'm going to lower the interest rate on reserves even more to expand monetary policy. And that's a mistake in this model. Because beyond that point, because the deposit rate is fixed at zero, and banks have to earn zero profits, and they have to hold reserves for settlements, if you charge them even more negative reserves, because you tax them more for holding reserves for doing this settlement, they have to compensate by jacking up the loan rate. So this is, entering this zone is terrible. You cannot lower rates because it's contractionary, and an open market operation is useless. So you're done. Central bank is gone. Can't do anything better. So,
I'm not sure I got it. If I tax reserves,
yeah.
don't they have an incentive to convert those reserves into loans and therefore lower the loan rate?
Yeah, but in this model, you don't convert reserves into loans. They're different assets. So the way it works is you raise interest rate on reserves. So you're thinking of a world where I can lend money out, and that doesn't happen here.
So why would the taxing reserves lead to an increase in the loan interest rate? It's some income effect of the bank?
So suppose that to make loans, I have to hold reserves. Reserves are like a complementary input to making loans. So if I tax you on that complementary input, I have to pass through that to the loan rate. In a standard situation, if I lower the rate, so I'm basically taxing you, right, I also lower the deposit rate, which is another complement. So you pass through to the deposit rate. So you don't have to raise the loan rate. But when you're at the deposit zero lower bound, it creates this effect. It changes the elasticities, essentially. Okay, so
sorry, I'm so confused, but
it's okay.
if I'm having if I'm reducing the interest rate on reserves,
Yeah.
is that expansionary monetary policy or
Here,
contractionary
yes.
policy?
Here is expansionary because you have the standard effects. Here it's recessionary because what happens is, so when you what happens is that when you lower the interest rate on reserves, so this could be zero, what happens is that the loan rate goes like that. The deposit rate goes like, just a second. The deposit rate goes like that. It's flat. You always have to make zero profit. So because you're charging an even lower interest rate on reserve, you start jacking up the loan rate. So it creates this reversal. So beyond this point, reducing rates is recessionary.
But according to conventional discourse,
Yeah?
if I'm taxing reserves, I am disincentivizing reserves, And so that's like expansionary monetary policy. No?
So
If I'm
conventional,
paying interest on reserves,
yeah,
then it's like increasing the reserve requirement. So it's like contracting monetary aggregates.
yeah, but it's working differently here. When you lower rates in a normal regime, you lower, something happens with the elasticity so that you lower the loan rate and the deposit rate. And because you lower the deposit rate and prices are sticky, you're lowering real interest rates for depositors and borrowers, and that stimulates aggregate demand. But when you enter this regime, the deposit rate can no longer fall. So when you lower the interest rate on reserve beyond that point, the reduction in interest rates is jacked up as a increase in the loan rate.
Okay, so it's because of the zero lower bound
Yep.
on deposit rates.
Yep. Okay, so
So imagine that there was no aggregate demand effect, prices are flexible.
Yep.
Understand that limit.
yep.
Then you still have this reversal, the same issue would happen, but it says shrink in aggregate.
So if you don't have sticky prices, then output is fixed.
But
So
it's still the case that the loan rate still has to rise when I'm at the deposit rate.
correct.
So what's the effect of a higher loan? So now
The quantity of-
inflation. Loan rate
Perfect.
goes up, deposit rate's fixed, rate on reserves goes down. What happens to
Perfect.
inflation?
So what happens is that because the loan rate is higher, but the deposit rate is fixed, the quantity of credit has to contract, and that's the margin of adjustment.
But that's on the left part, but on the right part, the loan rate is going up as I move to the left as well.
As-
no? I mean, the effect you mentioned.
So no. So this is the loan rate, and then I have to stop because I want to finish. But yeah, so the spread is constant in this region because the quantity of money is constant. So the spread is constant. But then if you go beyond that point, things work backwards. So, and I think that's why central banks haven't gone to minus 5%, in Japan. Anyway, so bankers complain about this. There's like plenty of Wall Street and FT.
Can you conclude in 1 minute?
Okay.
Sorry.
You owe me.
Yeah, I know.
Anyway, so effects of open market operations, first thing is like it's expansionary. Effects of reductions in interest rates, it's expansionary until the zero lower bound. It's just, this is the picture for what I described. And then the last thing I want to do is talk about normative analysis. So to talk about normative analysis, I need an aggregate shock. And I need the aggregate shock to be expected, because then I'm cheating otherwise. So long story short, what we do is we do like a Crusell-Smith trick where there's an aggregate shock everyone is anticipating, but to make things tractable, we have the shock occurring only once. So then you don't have the curse of dimensionality problem of Crusell-Smith. So this is the trick. Just if you want to study aggregate shock with heterogeneity, we developed this trick in another paper called the risky steady state. And what you do is you say, let's construct an economy where there's going to be an aggregate shock only once, and you can that one you can solve exactly. Not in paper and pencil, but you can solve it in the computer. It's not an approximation. You don't need a behavioral assumptions. You can solve the model. So that's what we do. And what we're going to do is we're going to do two things. So ex ante, before the shock hits, I'm telling you what the spread is. And after the shock hits, I'm telling you where to reduce rates. Okay? And the point of this picture is that you have an interior solution. Okay? So what that means is that after a shock hits, you want to reduce rates, but up to this point. Beyond that point is recessionary. So this is this point where the welfare cost starts going up is precisely when the negative interest rate on reserves triggers the deposit zero lower bound, A. B, most importantly, this has to do with the balance sheet policy ex ante. So remember that the spreads in this model are controlled by the quantity of reserves. So you don't want to have too low amount of reserves in the system, because if you do, you're hitting welfare. Your spreads are really high, so you're really affecting insurance in steady state, microinsurance. Unemployed guys, when they want to borrow, they borrow at high rates because there's no reserves and that's passed through to the loan rate. But on the other hand, you don't want to go beyond the point. You don't want to satiate banks with reserves because that compresses the loan rate or the spread. That stimulates credit too much. And that has the effect of reducing the monetary policy power, and it expands the effect of shocks. So you trade off along this dimension. This is a more interesting dimension. You trade off worse microinsurance at steady state for better macroeconomic stabilization when a shock hits. And
Saki, just very quickly.
yep.
Why can't I, let's say, close the spread, but just use the interest rate example to control credit?
Because you have a limit. If you can use the interest rate. That's within a possibility. You could go to zero, but remember you have a limit of the interest rate on reserves of the expansionary effect. Because you have a zero lower bound, you cannot go beyond a certain point. You're better off before you hit the zero lower bound, increasing a spread, contract the quantity of credit in equilibrium, so that agents are more responsive to interest rate policy and less responsive to shocks. Remember the message from, incomplete market models with nominal rigidities is you have different marginal propensities to consume. What a positive spread is doing is it's shifting the distribution to the point where the marginal propensity to consume with respect to income are lower, so the effect of aggregate shocks is lower, and the elasticity to interest rates is higher. So policy is more effective, shocks are less effective or less damaging. So that's the message, and that's a macroprudential story. So that's the end of the talk.
Okay, thank you very much.
So thank you to the organizers to give me the opportunity to discuss this very dense and very insightful paper. Actually, my discussion is not going to I mean, there's many insights, and I will not cover everything in my discussion. So perhaps what I want to do to start with is to give some background. And actually, what I really like about that paper is that it was connected to graphs, to data that I'm showing to students. So this is the kind of graph that I'm showing to students. That's the corridor system in the euro area. And as you can, so that was what happened before 2008. We had this deposit facility rate in green, the lending facility in red, and in the middle you had the interbank market that was actually moving up and down or around the marginal refinancing operations, so in a way the rate that the ECB was targeting. But something changed a lot, and this is what I'm highlighting to students. We shifted to a situation where this interbank market is actually not anymore at the center of this corridor. It's more and more at the floor, and over the last couple of years, it's actually exactly at the floor. And if you zoom in on the very recent period, and on top of that, you're looking also at what banks have in terms of reserves, you can see that actually they have a lot of excess liquidity. They have a lot of reserve that they hold on top of their required reserves, and this is what this light blue area is about. So the scale is actually on the right. You can see that those periods where you have a floor system is actually connected to a period where banks have a lot of reserves. It's not something that is peculiar to the euro area. If you look at the US, for a very, very long period of time, there were no excess reserves. That's the longest time series that I could find. And on top, the interbank market, so the Fed fund rate was actually above zero and above the rate that the interest rate that the Fed was paying, because before October 2008, no interests were paid actually on reserves in the US. And that has changed actually. So just here, and as you can see, you cannot see it because it's very small, but in green here, there is this interest rate paid on reserves in the US, and you can see that the Fed funds is actually following that, more or less that rate. And on top of that, banks have accumulated a lot of reserves since then. So then what I'm showing to students is actually those kind of graphs that are actually coming from a policy paper by Keister in 2008, Keister and co-authors, where they were already illustrating those two regimes that we've just seen on the two previous graphs. The first one being this corridor system, where by targeting a supply of reserves that is generically above the required amount of reserves, gives you an interest rate in this corridor. As you can see, the constraint to get that target rate here is that you're not going to satiate the demand for reserves. You're not going to be in that area that is here on the right of that graph. This differs actually from the floor system, where you're doing the things completely differently. You're actually setting a level of reserve that is above satiation, and then marginally you can actually change it without any effect on interest rate. And with your interest rate on reserves, you can actually target a rate on the interbank markets. So in a way, in this second regime, you're flooding the market with reserves, and then by manipulating this interest rate on reserves, you're managing this target rate. So, but what I'm not explaining to students is, what's the best regime? What's the best solution between this corridor and this floor system? And this is what this paper is about. So, in a way, we are currently in this floor system. We are thinking about the new normal, the new way to do monetary in the future after this experience of the floor system. And the question is, do we need to keep that system, or do we need to go back to the corridor system? So what are the costs and benefits of those two systems? What this paper is doing is to build a model. And I think that the main ingredients of that model are the following. First, heterogeneous agents that are facing unemployment risk, and they need to manage this unemployment risk, or they need to manage this unemployment risk by self-insuring, either using deposits or debt. Banks actually are transforming deposits into loans, into that debt. But the main problem is that those banks are facing payment shocks, and they are trading frictions in the interbank market, so that there is a role for reserves. And this is where the central bank is stepping in by manipulating both the price, in a way, through the interest rate paid on reserves, and the quantity of those reserves. The main result, to me, is that the corridor system in this paper is something that may be desirable, but at a cost. And this cost is this reduced macroeconomic insurance. Right? And why we should pay that cost, why we should actually have less macroeconomic insurance, is to have, on the other hand, better macroeconomic stabilization by reducing macroeconomic insurance. The authors are showing that you can actually have a more efficient way to stabilize the economy through simply closing the spread and cutting interest rates, or reducing this interest rate paid on reserves. Okay, so perhaps let me have some better explanation or better view for me on the mechanism. And actually, I'm going to show you graphs that are directly from the paper that I find very illuminating. So, desire spread as why you want to reduce macroeconomic insurance. Why is it important, and why is it connected to the ability of the central bank to stabilize the macroeconomic activity? So desire spread in a Ayagari-Bewley type model, they have two effects. For everybody that is above zero, they are going to, in terms of net wealth, they are going to reduce saving incentives. So for everybody, so that's the distribution of households with respect to their wealth. Zero is there, so people that have net positive wealth are above that above zero. So for all those households, they are going to have a reduced incentive to save. On the other hand, if you have a higher spread, that means that you will pay higher interest on your debt. So it's a reduced incentive to get more indebted. And so if you look at the effect of raising spreads in that economy, you will obtain exactly those two graphs for employed and unemployed. Actually, in blue here in the middle, that's the distribution with the spreads to 0. And you can perhaps see this, but in green on top here is the distribution with the spread equal to 1%. And I don't know if you can see, but it's the distribution between low spread and high spread is getting more concentrated. So you're going to have less people at the bottom of the distribution with higher spread, and you will have less people also at the top of the distribution. By the way, a parenthesis that it's something that is not necessarily mentioned in the paper, but if QE has an effect on, or if quantitative policies have an effect on spreads, reducing spreads, there is also an effect in terms of inequality and the level of inequality. Actually, inequality is rising with the size of the balance sheet of the central bank. But it's something that is not necessarily mentioned. But this has also an effect in terms of the efficacy of monetary policy. And why? Because of what is going on the left part of the distribution. You have less people at the constraint. And we know that if you have less people at the constraint, that means that you have less people. We will have on deposit more people that will react to interest rate changes because they will not be constrained by this borrowing constraint anymore. And to me, that's the key mechanism explaining why you have a better efficacy of monetary policy when you have less macroeconomic insurance. Actually, it's because you have less people at the constraint and you have a more concentrated wealth distribution. Okay, so that's how I understand the core of the mechanism. So let me perhaps make some comments. The first one is a little bit of an unfair comment. So let me make a step back. In a way, what you're saying is that, I mean, there is a simple way to have a better macroeconomic stabilization. It's to go to this corridor system back. There are other ways to do better macroeconomic stabilization. From the New Keynesian literature, we know that there is forward guidance. There is also the possibility to raise the inflation target. So there are many ways to do this. And actually, even in the paper, there is another way to do it. What is key for having your mechanism is to have trading friction on the interbank market. This comes from the fact that the interbank market here is decentralized. But, I mean, there were discussions, at least Rocher-Tirole 96, about whether we should think about centralizing the interbank market with the central bank being the intermediate, and with a double auction system, banks could either lend or borrow liquidity from the central bank. So my first comment is, okay, we have many other policies that can help to either reduce this trade-off or do better macroeconomic stabilization as well. So in a way, why I should consider the corridor system necessarily as the solution or the best, second best solution to macroeconomic stabilization when it comes to dealing with a lower bound constraint on that kind of economy. By the way, connected to this, what is also key is that you have a funding liquidity risk in a way for banks, and that is the main driver of the spread between loans and deposit rate. Just a side comment: is it something that we can give substance in terms of empirical evidence?
You gave it in your first slide.
Well,
let's discuss this perhaps. I'm not so sure, but okay. So then I have perhaps more technical comments is about the real interest rate. So it's something that is extremely important. As you actually detail very nicely in your presentation, monetary policy has, in that environment, the power to determine this real interest rate, the long-term real interest in the economy. So I think it's something that is actually key in that literature. So there is another paper by Arsène Nuno-Thaler and Thomas, in which actually this real interest rate is key. In their case, it's not determined by monetary policy. It's an exogenous subject in the steady state, because it exactly equals the discount rate of the representative households. And then any spread that is introduced is actually going to limit the space for macroeconomic stabilization, because it is going to be to push the interest rate paid on reserves at a lower level compared with this fixed long-term interest rate. Here the things are completely different because you have this Bewley-Ayagari environment, but still I expect this R to decrease with the size of the balance sheet, but in a way not too much, so that it should not, in a way, limit the space of monetary policy intervention as in Arce et al. But still, I have a question there. Is there a point where spreads are so large that the interest rate goes to the real interest rate goes to zero, and so also limits the ability of the central bank to cut rates? So in a way, is there some kind of a non-monotonicity in your argument? I'm going to go very quickly on this. So something else that is important in those models is that you may have different redistributive effect depending on whether you include capital. So here you do not have capital, but if you were to have capital, you would have another channel of redistribution, and sometimes you may, so through wages actually. So if you have more capital in that economy, wages are going to go up, and this will redistribute wealth to the poorer households. And so the question is, does it change the trade-off in terms of microeconomic insurance and macroeconomic stabilization when introducing capital for that reason that was actually pushed forward by Davila et al. In an economic paper in 2012. Small comments, but I'm going to skip them. So it's really a great paper to conclude. So I think it's very useful to have a framework to think about this interbank market in a general equilibrium, and to run normative analysis on this. Perhaps there is some, as I said, the paper is very dense. It's also very polished, but still there are perhaps some dimension along which we want to know a little bit more, for example, about this real interest rate. And again, if the interbank market is so important, if its structure is very important, so why not changing the structure simply, and rather than doing the corridor versus the floor system? So thanks a lot, and I hope I have not.
It's something that I hear often in many presentations. So I think it comes from the fact that the welfare theorems are both a blessing and a curse. They're a blessing because they're a beautiful benchmark, but they're also a curse because we're always tempted to think, well, whenever we see a model in second best, why don't we introduce extra? Why you continuously ask, why don't you add more instruments for the policymaker? And we know that with an ideal transfer program, you can recover first best in this model. So then the natural question is, are the frictions that you have, are they reasonable? And here I think they are very reasonable, because if you think what's going on with banks is that they're really, for whatever reason, for whatever information reason, they're really issuing joint liabilities, and that makes them special. I mean, they're the only institutions whose liabilities circulate from one bank to another, and they absorb them. So that system is naturally, if you can issue liabilities that are absorbed by another, that system is prone to to problems. And I think the reason why you have these over-the-counter markets is because, you know, banks meet and they negotiate and they use information, and that's a timely process to precisely prevent them from issuing liabilities like crazy. So that's my answer to why those over-the-counter market frictions are natural. But then the second question is, well, the central bank could overrun that by running a Friedman rule, just satiate banks with reserves. Go to that's what, like, in the policy discussions, like, we're adding distortions. Mike Woodford says that. But I think that's a mistake, because, you know, the central bank can exploit those frictions that, in a way that, if there are other problems in the economy, distortions in the economy that you cannot solve, like aggregate demand distortions, then you want to ride on those frictions to become more powerful. So that's the spirit. And then the second point you brought with a paper with Arce et al. And regarding I think that's a very clever point. So what you're saying is, look, in a Niagara model, if you jack up spreads or if you tighten the borrowing limit, real rates will drop. The message in Niagara is you're the best you could do is, like, raise rates as much as possible. So indeed, I think if you start jacking up spreads, you eventually converge to an economy that is an autarky. So there's going to be a lower bound on the real rate. That per se has no consequence for the zero lower bound, because, you know, the zero lower bound depends on nominal rates, not on real rates. So zero lower bound applies to nominal rates. However, if you do something with your Taylor rule that, you know, tries to keep inflation constant, if real rates fall and you, as a consequence, drop nominal rates, if you want to keep inflation constant, then you're exposed to being closer to a zero lower bound. So in some sense, if you had that effect, it's bad for that reason. So I think it's a very clever point. I hadn't thought about it.